On this episode, I'm going to share with you some common loan and lending terms. Welcome everyone to this episode of the Ask Jason Gelios show. I'm Jason Gelios, Michigan Realtor. Really appreciate you guys tuning in here. I hope everyone is doing well. We have some vocab that I love to share with you in regards to loans, lending terms, things like that. So I put together a little list that I want to decipher for you. But first, be sure to, if you haven't done this already, follow me on social media, hit like, follow. If you're on YouTube, go ahead and hit subscribe and hit the bell so you don't miss out on future episodes. Plus, my in-between videos that I upload, from my real estate rants to market updates to general topics that pop up in the real estate industry. I'm going to share with you in this episode some terms that you may have heard before, right? You may have heard about the actual word term and fixed rate, adjustable rate, balloon mortgage, all this stuff. And so I'm going to share with you some of these. Now, term, right? Mortgages have terms, which, by the way, all this is pertinent to purchasing a home. The word term, right? Well, what is that? We've heard about this, term, right? We're not talking about term paper. We're talking about mortgage terms. There are 15-year mortgages. There are 30-year mortgages. Years ago, there was a 40-year mortgage. I'm not sure if that's still around. It might be around. Ask your loan officer. And if you don't have a loan officer, I can refer you one. That was actually interesting back in the day with the recession. It was, pretty interesting how we had a 40-year fixed rate. I don't recommend that at all. But a term is the length of your mortgage. And so that's the first vocab term that we're talking about. Next one is fixed rate versus adjustable interest rate. Now, obviously a fixed rate means that it's fixed. It's not going anywhere. It's not going to jump up on you after a certain amount of time. You see a fixed rate mostly on 30-year terms and sometimes on a 15-year term, if that's what you choose. But basically, 30-year term fixed interest rate is the most common, especially if you're a first-time home buyer. That's just what many people gravitate towards. So adjustable rate is when the interest rate adjusts after a certain period of time. It could be anything. It could be 3 years, it could be 5 years, it could be 7 years. It just depends on what the lender offers and what you choose. To where a fixed rate is a fixed rate. It doesn't go anywhere. You know what your payment will be. No matter, even if you pay more on your mortgage, if you pay more towards the principal each month, your payment stays the same. Towards the end of the loan, you'll be paying more towards the actual principal. However, what you see is the rate stays the same. Another one, non-traditional mortgages. I don't get into this a lot, but they sometimes call them exotic mortgages. They're rare. Before the housing recession, prior to 2007, right, there were a lot of exotic mortgages. And what do I mean by that? Well, what I mean by that is you had more creative options. So, for example, a common exotic mortgage was a 10-year interest only mortgage. So what that meant is you had an interest only payment that would not apply any of your money towards the principal, which sounds like a horrible idea. But some people were responsible with this. I remember when I was in the mortgage side of things, it was common for those types of loans to be for people who, let's say they got bonuses in their career towards the end of the year. They would actually apply more, but they would have a lower payment throughout the rest of the year. Attorneys liked this loan, right? So anyway, exotic mortgage could apply. That's probably the best example that I have, is that an interest-only mortgage, 10-year interest only, and then after that 10-year term, it goes up, I will say jumps up to a regular principal, interest, tax, and insurance payment. A balloon mortgage. Now, we're not talking kids' balloons, right? We're talking a balloon mortgage, okay? It's non-traditional financing where your interest rate is low for a certain amount of time and then it adjusts. Most people can't stomach that. They live based on that lower payment, and what happens is it balloons and it goes up. hence the term balloon mortgage. Government-backed loans. I love government-backed loans, and I'll tell you why. Because I work mostly with first-time home buyers. I love educating first-time buyers. They love to learn about the process and what they're going to be doing when they're searching for their new home. So I would say they're my niche. And the reason why I love government-backed loans is because they are government-backed. It's less risk for the lender, and they usually have great options to allow first-time home buyers in general, or veterans, to get into a home with a great interest rate and great options, okay? VA loans, right? Those are common where a veteran obtains a VA loan, and it's just a huge option. Ask your lender about these options. I don't dive into the details of mortgages. It's been a while since I've been in the business. However, I know people that are experts at lending, and I let them, those experts, do what they do best. These are some of the terms that I wanted to share with you and when it comes to lending. And these are probably the most common and one of the most important. So I hope you guys found value in this episode. I really appreciate you guys watching. Be sure to, again, follow me on social media, hit subscribe on YouTube, hit the bell so you don't miss out on any episodes that I upload. This show is uploaded once a week, so I really appreciate you guys watching, as well as providing the questions that are the fuel for this show. I'm Jason Gelios, Michigan Realtor.